Hello and welcome to Raise Your Average. I'm Pierre Daly, managing editor at advisoranalyst.com. Co-hosting with me today is Rodrigo Gordillo, president at Resolve Asset Management Global. Our very special guest today is John Goey, senior investment advisor and portfolio manager at Wellington Altus Private Wealth. He's the author of a multitude of books on money, investing, and the industry we're in, titled Stand Up to the Financial Industry, the Professional Financial Advisor series, and his latest book just released, Bullshift: How Optimism Bias Threatens Your Finances. John has over a quarter century of experience as an advisor to professional and wealthy retail clients. In that time, he's built a stellar reputation for client responsiveness and helpful advice. He's one of only about 70 planners to be awarded a Fellow of FPSC distinction, and one of only 8 people to be awarded the Donald J. Johnston Award for lifetime contribution to financial planning in Canada. Over the course of his career, he's had the privilege of meeting such industry giants as Nobel laureate Robert Shiller and industry icon John Bogle.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
John, welcome to the show. It's terrific to have you. We're excited to talk to you.
Thank you, Pierre. Pleasure to be here.
So, John, to kick things off, please tell us about the arc of your career, how you got into the business in the first place, and how you've evolved since then as an advisor and a PM, and also as a person.
I guess the question is, how much time do you have, Pierre? Because this could take some time. I'm one of the relatively few people in finance who actually was actually looking at working in government. So I did a graduate degree in public administration, a master's in public administration, which is like an MBA only for government. And while I was doing that, it was a co-op program at Carleton in the nation's capital, and it had an opportunity for me to sit in on hearings with regard to what was then the new public policy of the goods and services tax, the GST. And in my work in making briefing notes for the senior managers and government bureaucrats, I realized that I was a bit of a consumer advocate, and that sort of came out sort of unexpectedly. I didn't realize that that's what I was, but it became clear to me that that's sort of who my identity was. So when I moved to Toronto with a degree in public administration, and we had Ray days, and obviously there aren't a lot of jobs federally, and there was a hiring freeze on provincially, and there were no jobs at Queen's Park, I ended up having to take my skill set and become a financial advisor, because a lot of the core courses are the same. Over the course of my career, this is now my 30th year, I've developed an affinity for financial planning principles, and developed a decent sized number of clients, and I'm delighted to serve them. It's one of the great joys in life, and is being able to help clients. But along the way, I've written maybe 200 articles and done a bunch of TV spots, and this is now my third book, Bullshift. And in all cases, the books are being written in a way that helps consumers and advisors work more constructively together, so that maybe helping consumers to sort of debunk what does and does not take part in the industry, so they can understand the industry better and hopefully have a more productive relationship with their advisor.
I think one thing I would remark about sort of knowing you by reputation and having read some of your work over the years, seen your articles in different places that you've published, you've never been afraid to go out on a limb, in order to make a point to at both advisors and consumers. So, I think that speaks a great deal to your motivations and your agenda in the industry, what you're hoping to accomplish for your clients, and also how you aim to help advisors.
Yeah, I think if there would be one overarching theme here, I think it would be a commitment to evidence. And there are a lot of things that people in the financial services industry, both advisors and investors, that they hold to be true, that they believe to be true, but that are oftentimes less than true, and in some instances even demonstrably false. And so part of my job is to help consumers to be better consumers of financial advice so that they can sort of sift through the bullshit and actually get advice that's based on their own interests and based on things that can be proven as opposed to wives' tales.
Yeah, I would
Yeah.
say, I wouldn't say that John has been out on a limb. I like the idea when I look back at everything John said over the years, I think it's speaking truth to power, and power being kind of what the average industry member believes the proper way of investing is, right? I mean, speaking about going out on a limb, let's talk about the title, bullshit.
Well, you know
How
what?
optimism bias threatens our finances.
It's a great title. Rod, thanks so much for correcting me. I think that's maybe I used the wrong idiom or the wrong expression, but I think I think courageous is the sentiment. You've never been afraid to say things that some people just wouldn't, might not want to tread there. And so your willingness to go over the line, that most people won't cross, is courageous. So,
yeah, thank you. I think there's a certain amount of career risk that comes with being forthright and speaking truth to power, and that's just the sort of thing that you need to come to terms with. And I've made my peace a long time ago that it's not like I'm not trying to annoy anyone. I'm not trying to get people upset, but by the same token, I get upset when people say things that are less than truthful, and then I feel that it reflects on me if I don't correct it, because if you say things that are false, if someone says something that's false and now I don't correct it, now I feel that I'm basically complicit in what's being said. So it's not even me even going that far out of my way to say certain things. I just correct things when I see things and hear things that are less than accurate.
Well, so let's John, let's talk about bullshift, and because I think it'll set the table for our entire, maybe a wider conversation around the topics that you've opened up in the book. First of all, what is it about?
Okay, so I'm going to hold up a copy of it right here so you guys can see it, of course. But this is what it looks like if you're going to look for it in the bookstore. The subtitle is How Optimism Bias Threatens Your Finances. In the basic premise is it sounds a lot like another word, and that's deliberate. But most of the time, one of the things that I would say about optimism biases, because the book talks about many, many biases, and we all have them. Every single person on the planet has biases, and we can't avoid them. The best we can do is address them, manage them, be mindful of them, and try to mitigate the harmful effects of those biases. There are dozens of them, and most of them are at least somewhat harmful. Most people would agree or would say that in their view, perhaps the best bias is optimism bias. So I sort of zigged when the industry zags by talking about the risk of optimism bias in particular. But it's the sort of thing where you need to realize that if you're not sufficiently prudent, not sufficiently careful, if you think, oh, this is going to be fine, that's when you let your guard down, that's when you open yourself up to being broadsided, because you weren't as careful as you might have been because you were told that everything was going to be fine anyway. So that's, in a nutshell, what the book is about.
So this, obviously we're in an industry that's full of behavioral biases across the board, right? So the question really is why did this happen? Why did we have this particular positive bias spin for a particular asset class? Because I think we're dominated in this world by equity risk across most portfolios. Why do we think we ended up here versus the plethora of other ways of dealing with both emotions and portfolio construction?
One of the things advisors talk about, one of the big selling points of the industry is that advisors can work as behavioral coaches. And I'm actually being quoted in an article today by a publication called Wealth Professional about a recent study from Russell, sort of talking about how advisors can sort of add value, quote unquote, through their behavior, through a whole number of different things, but perhaps the most notable of those many things is behavioral coaching. And I think the easiest answer to your question, Rodrigo, is that if you think about what you want investors to do and what successful investors have historically done throughout the generations, a lot of that is part and parcel with being optimistic, staying invested, not panicking, doing the various things that are sort of the financial investing 101, financial planning 101. And those are all things that are predicated on being optimistic about the future. And don't get me wrong, I'm not a pessimist. I bristle at anybody who accuses me of being a pessimist. I'm inherently optimistic like everyone else. I just think that optimism needs to be tempered with a reasonable degree of realism. And I think there are some people in the industry and some people who are clients of people in the industry and some people who just work as investors on their own as DIY people who are overly optimistic and don't even realize it. And it's not until we actually have a significant downturn that these people will realize that they were overly optimistic. And unless and until we have one, the theory of what bullshit involves and the risk that people are taking as a result of an optimism bias remains largely untested. So I guess what I should say is the book is, if we have an event, if markets do something like what they did in the 30s with the Depression, none of us have ever experienced that. It was 75 years ago, and all investors today think, oh, it's fine. Whatever happened in 74, I read about that. And what happened in 87, I read about that, but we got through that. But then we have like the technology bubble at the turn of the millennium and the global financial crisis. And they got through that too. And in fact, even COVID, which was just a little over 3 years ago, people say, oh, I got through that. Well, geez, peak to trough, that was only a 5-week drawdown. Like, yeah, of course he got through it. It wasn't that long. But what happens if we actually have a situation where, and here's an example that I'd like to use, you guys would know this, the Nikkei 225 hit its all-time high in December of 1989. It still hasn't gotten back to that level. Mm-hmm. And people who say they're long-term investors, they can be a long-term investor, but when they talk about that, what they have in mind is, some people say, well, I got through the COVID crisis because I'm a long-term investor. It was 5 weeks. What you need to do is you need to realize it could be 5 years and it could be 10 years. Yeah. And a lot of people who think they're ready, who think they're prepared, who have said they're psychologically sort of prepared for it, they don't know because they've never actually had to do it. So I'm not saying they're not prepared, but I'm concerned that some of them won't be prepared because what they think they are prepared for is going to be a walk in the park compared to what they might actually experience at some point.
We've been, I think just to circle back to your optimism bias, we've been led to believe that, if you just wait, if you're patient, things will turn around. But I liked, there was something that you quoted in your, is an article from last year, from February of last year, that's you've got posted on your site, John, which was the acronym TIARA. And, we heard all about TINA and all about FOMO, during the 2020-21 period. We spent, Rod, we spent basically the entire year of 21 and 22 talking about alternatives and strategies. And, it was all during a time, at least in 21, it was all during a time when nobody was interested in alternatives. They were there, they're available, they're accessible, since 2019. If you're high net worth, they were always accessible. But the impetus to do that just wasn't there because 60-40, bonds and stocks were continuing to do great right up to the very end of 21. So, here we are, we've had all of 22 to contemplate what to do with a 60-40 portfolio. We had all of 2022 versus 2020, of course, is the context I'm saying it in, to adjust our portfolios, to add alternatives, to look at alternative strategies, to contemplate doing different things. And I love that that was actually, reading your article, John, that was the first time I saw that acronym, that crafty little acronym TIARA, which is, there is a real alternative.
Exactly. So thanks, Peter. I'm pretty cheeky. I come out with these things. The bullshit is a cheeky idea. Stand up is a long-winded acronym. It stands for scientific testing and necessary disintermediation underpin professionalism. Yikes. That's a hard thing to say. But yeah, there is a real alternative. And I think a lot of people are so blinkered in their ongoing commitment to traditional ways of doing things that when new things come forward, new things sometimes take longer than they ought to become adopted because my experience is that the financial services industry is quite conservative, and no one wants to go first with something that's new and different, people seldom, obviously someone has to go first, but most people are reticent to go early on, to be early adopters, because they are mindful of, well, what if it doesn't work out? Now I'm going to be the one who looks bad because I brought this new idea to my clients and it didn't work out. So you go first, and if it works out, then fine. But I don't want to go first, because no matter how much the logic, the back tests, the various evidence might be, a lot of people are just afraid to be the one who goes on a limb, for fear that their clients will hold them personally responsible if things don't work out exactly as they sort of preset the expectation.
I had a very interesting conversation today with a large advisory group in Canada, and we made it to the final part of the conversation. See the value add of doing something that adds more balance to your portfolio, your inflationary regimes and bear markets, blah, blah, blah. And it ultimately came down to, it's just a problem is if I take this to the department, the compliance department, they're going to put it in as high risk. And, how do I explain high risk to clients? It's just too much for me. And, what I said to them is like, if for whatever reason, I'm not calling a shot here, but for whatever reason, we end up in a period like that 2000 and 2010 period, or the 1970s to 1980 period, then you're going to be uncomfortable either way. You're going to be uncomfortable with having bonds and equities being highly correlated most of the time and providing very low returns that your clients really can't live off of, right? So you're either having to deal with the pain over the next 10 years with clients, or you're going to have to deal with the pain of learning about what you need to do in order to create balance in portfolios, speaking with your compliance department to make sure they understand that you understand the risks and why it's actually less likely to be less risky. And there's no ifs, ands, and buts about it. You just simply have to get comfortable with being uncomfortable. Right? That's it. And it's one or the other. You got to choose your poison.
Rod, I have a thought. I have a thought. Sorry, John. And just quickly, I have a thought, which is, when is the compliance officers conference?
I don't know.
When do they get together for a powwow? For a compliance officer jamboree, like where where you could actually get an opportunity as a practitioner in alternatives to speak to that group of officers and educate them on.
But they know.
The actual risk.
What I said to this group is that these are reasonable departments. These are reasonable people. And when I was doing private wealth back in the day, I invested 100% of my clients' portfolios in this very unorthodox approach that they were originally uncomfortable with. But I put together the time, laid out the case, put together a report, showed them the risk-adjusted results and how this would be better long-term, and that I'm fully explaining these to clients up front, and they're okay with the tracking error. And guess what? They said yes. They signed off on it, right? So it's just a matter of you have to get comfortable with being uncomfortable and talking to your compliance department, putting in the work, understanding it, and making sure that you're not caught in this bullshift where you've been sold that that's the only way to manage money, and it really isn't. Right. So
it takes grit, though, doesn't it? It takes a certain amount of grit, and it takes
or
courage.
A decision to do it. Right. Because again, it's going to be tough either way.
I absolutely, by the way, Rod, I absolutely love your story, about the 08-09 period and what you went through. And and I say I love it, but it's almost a poignant tale, like where you did the right things, but there was another price to pay for it, not the direct pain of loss, but sticking out like a sore thumb somewhere.
Especially
right?
as the bull recovered the next year in 09, right?
Being a source of resentment.
So this is it, and we need to. I think it starts with education. I think, John, what you're doing in your book is exactly what the Canadian audience needs. But let's talk a little bit about how we talked about the bull shift mentality and the behavioral flaws that come with it, but let's start shifting away from the bullish scenario and talk about what do we think advisors and investors need to start thinking differently about in order to move away from that paradigm in case we get a 1970 style decade?
Without getting into a forecast. So what I'm about to say is not a forecast, but rather a cautionary tale, a what if. And I don't know what the future holds, but if we have a major drawdown, the first thing you can do is you can sort of sit down with yourself or with your advisor, if you're working with an advisor, or if you're working on your own, and write down what you commit to and how much of a drawdown can you withstand, and what will you do if you experience that, and do you resolve to stick with it if you experience something that and if not, when will you change your strategy and when will you de-risk? Because obviously the best time to de-risk or to reduce the risk is before there's a major drawdown. But of course, if we knew that with perfect hindsight, we wouldn't be having podcasts like this because everyone would do it in advance. I think the point that I would make is that a lot of, wearing my financial planning hat, a lot of people that I come across use planning assumptions for rates of return that are oftentimes in the high single digits. And FP Canada, where I'm an active volunteer, you mentioned this off the top here, they're saying that a reasonable expected return for equity is somewhere between 6.5% and 7%, and for income it's more like 2.5% or 3%, and that's for the benchmark. And then you've got to take off the cost of your products and the cost of your advice, and what you're oftentimes left with is at best mid-single digit return expectation for a reasonably balanced portfolio, and even a very aggressive low-cost portfolio will still be a medium to high single-digit return expectation and not much more. And so a lot of people, when you think about the combination of returns being lower, risks being higher, and longevity being more of an ongoing reality that people used to, 30, 40 years ago, people would retire at 65 and be dead at 72. Well, now they retire at 62 and they live to be 85. And if you're working with wealthy people like I do, professionals, because of lifestyle and health and better medical understanding of what they can be doing, a lot of them live to be well over 90. So now we're talking about a life in retirement that could last 30 years. And if you have a life in retirement that's 4 times longer than your dad or your granddad, and the returns are lower, are you sure you saved enough? Because a lot of people think they have, because they're using paradigms that are rather dated. And no one wants to be the bearer of bad news and say, well, actually, Mr. Jones, yes, you've got an nest egg of $1.25 million, but given the burn rate that you're talking about, you and your spouse going through, and given what we believe is a reasonable assumption for your actuarial projections going forward for the two of you, you probably have to work another 3 or 4 years and then save a large percentage of that money for those 3 or 4 years in order to retire and stay retired with the lifestyle that you're telling me you want to be able to realize. That's a difficult message for a lot of people to deliver if they're getting advice. And again, I don't want to be the bearer of bad news. Don't shoot the messenger. I'm just saying that the reality is that a lot of people will have their clients be disappointed, but their clients are happy now. The disappointment's going to come in 20 or 30 years when they realize that they were bullshifted in 2023.
Yeah, you can't say enough for aggressive capital assumptions and overly conservative longevity calculations. That's it's better to have the pain now and the pleasure later than the pleasure now and the pain later. And in retirement, people have very few options, obviously, available to them to make up for those kinds of mistakes. But yeah, that's something, Rod. That's something you guys have talked about a lot too, which is, it's one of the core principles that guides your practice as well, which is making sure that you're doing the right thing for your investors, making sure that those things are borne in mind as well, right?
It's just making sure that we are coming at this problem of investing with eyes wide open. That's it. That's really what it is. Because right now we've gone through, and I don't blame anybody. This is just human nature, right? We've gone 40 years from 1981 to basically 2020, 40 years of this, the great moderation, right? An amazing decade in humanity where we opened up ourselves globally to global trade, cheap labor, abundant liquidity, persistent positive growth. And in that environment, what kept floating to the top was domestic equities and domestic bonds were going to win. These are the asset classes that are going to do best. I mean, the idea of a 60-40 portfolio is less of a theoretical framework and more of an empirical framework of people's lived experiences, identifying how markets, look what's working, right? I like that equity in that bond, but more equity than bond because I want to make more returns. And they kept reinforcing that because year after year, we know upfront that this inflationary growth is good for those two asset classes, right? But maybe, John, you can speak to the risks of only having that myopic view of history of the last 40 years and what you suggest for people to think about in terms of risks that they may not be currently covering.
Good. So that's a great intro, Rod. So what a lot of people haven't thought of is that from the very early 80s until really the end of 2022, we had a 40-year long bull market in bonds. So the great moderation, perhaps you are referring to, the globalization and other things as well. But to me, the defining experience, the investing lives of virtually everyone watching this presentation today is that they have been investing exclusively until the end of 2022, beginning of until the end of 2021, in a prolonged, sustained, overarching bull market in bonds that has provided a tailwind and pushed things forward, and that bull market in bonds is now over. We've had, not only have we had significant rate hikes in 2022, and they will be continuing at least until the beginning of 2023. But in addition to that, we've got this ongoing inflationary pressure that will cause rates to stay high-ish, not suggesting they're going to be ridiculously high, but even rates at 3.5% or 4 or 4.25% will be higher than most people have experienced in the recent past. And they'll be complaining about, I don't know how we can possibly, make ends meet because I have all this debt, I have this mortgage. Look what's happening to my mortgage payments. Look what's happening to my debt load and my line of credit and whatnot. In fact, these rates at around 4% are not radically out of line with what they have been on average throughout history. It's just that a lot of people have become spoiled in the past 40 years, and they think that the recent past or the past of their entire investing lifetime is somehow going to be a prologue to what the future holds. And I don't think that's a reasonable assumption. And so now we have to, again, I don't want to be the bearer of bad news, but I think a lot of people haven't really stopped, thought about it, taken a sober assessment of the world that we live in right now, and then said, okay, well, the world has changed. How is my investing strategy going to change? What will my asset mix look like? Can I maybe incorporate some alternatives? Can I maybe revisit the idea of 60-40 as being the best way to do things? And the answer is not necessarily you have to change, but can you at least think about it? Is that much to ask that you can at least reflect upon what you're doing right now? And given that we're in a situation right now where we have the most prolonged and most severely inverted yield curve in both Canada and the US in modern history. And we're still hiking rates into this inverted yield curve. If you think you can skate through this, bully for you, good for you. I more power to you. I, for one, cannot in good conscience say that you should just keep on doing what you're doing without stopping and reflecting upon what you're doing and whether or not you should assess what could possibly go wrong. And again, it's not a prediction that it will go wrong, but I think you're being foolhardy if you don't acknowledge that there's a reasonable, in fact, a strong chance that something can and will go wrong. This has been, I think this is the most widely anticipated recession that, as the date of recording, it hasn't even happened yet, but everyone says it's going to happen. So if it happens, don't anybody come back to me and say, I didn't see it coming, or why didn't anybody warn you? My goodness, everyone's been telling you this has been coming for at least the past 5 or 6 months. We had the chairman of the Federal Reserve going around in Jackson Hole back in August, 5 months ago, saying there will be pain, and we haven't really experienced pain yet. So you think because we haven't experienced in the past 5 months, we're not going to experience? I don't think so.
There is an element. I mean, yeah, go ahead. Go ahead, Rod.
So I'm curious. So we have identified that there's a hole in understanding. What you're advocating is for people to take a look at whether that's enough. You mentioned alternatives. Like, what are the things that investors and advisors can start taking a look at to open their eyes and open up their perspectives to shift away from 60 and 40?
So the one thing I like to ask people is, when was the last time you really reread your investment policy statement? And if you've reread it recently, when was the last time you rebalanced to reflect that investment policy statement? And if you are in fact concerned about things being frothy, and the investment policy statement calls for, let's say, 60-40, but it's allowed a 10% wiggle room, maybe you could put 10% into alternatives. Maybe you could go from 60-40 down to 50-50. But what are you doing to take risk off the table if in fact you can see that there's a likely storm brewing on the horizon? Maybe you can go from growth stocks to value stocks. Maybe you go from long duration bonds to shorter duration bonds. Maybe you can do a little bit of all of the above. I'm not telling you what to do, but I'm telling you to at least look at what you're doing to see what works for you.
Well, yeah, very, very well put, John. I think the choice that investors have been making most recently in the last 2 quarters is de-risking in favor of short-term instruments and short-term bonds, short-term credit, right? To take advantage of those yields that, frankly, they weren't there, a year and a half ago, 2 years ago,
even 1 year ago.
Yeah. So I mean, that's the new. That's not an alternative. It's just cash. It's it's cash instruments or short-term instruments, short-term bonds. But
that's
not.
So what I'm saying is that that at least counts as something. You've looked at it. You haven't just sleptwalked your way through setting it and forgetting it. You've at least stopped. You've had a careful, purposeful reflection about what you're doing and why you're doing it, and what, if anything, you could be doing differently. And at a minimum, you should be doing that.
Yeah, and that's basically yeah. Go ahead. Sorry, Rod. Go ahead.
Yeah, I think the interesting thing about all this is, you have a change in yields in the short end, right? One of the other changes that we've experienced, going back to your investment policy statement, John, is that why are we doing these allocations, right? Historically, we want to have some bonds and we want to have some equities so that you can have 2 pistons in a motor that kind of offset each other in good and bad times, right? And what that has done historically when thinking about investment policy statements is you can kind of put a little thumbnail as to what type of volatility, maximum losses you can expect when indeed the equities and bonds are offsetting each other. And so we've experienced a level of volatility over the last 40 years that's run around 10 to 12% annualized standard deviation. Okay, so just to put a number on it. That is because of non-correlation. It's because of zigging and zagging. Over the last year, when equities and bonds have moved together, what's happened to the risk in that investment policy statement? What's happened to that portfolio? The risk has gone up.
Yeah,
we're seeing 2 pistons move up together, right? So you got to examine your investment policy statement and what the purpose of it was, which was protect downside, given your personal willingness to take a downside correction. Protect the ups and downs and the gyrations of your portfolio, because that's a little scary. And then you have to do something about it. Maybe a first step is to add some cash so you can get back down. If your investment policy statement, they can get back down to the volatility, but you might be leaving some returns on the table. And other options to look at are now with the new liquid alternatives rules that allow you to invest in something that is a third piston in the portfolio that may zig when everything else is zagging. You might be able to even reduce portfolio risk further, right? Going back to why equities and bonds reduce risk in the portfolio in the first place. If you find something that is going up when equities and bonds are going down, then you're in good shape, right? So these are the areas that you need to be aware exist that didn't exist even 2 years ago. Examine the landscape, right? I think you would endorse this, John. Like, the idea again is really to just take a step back and reassess everything, right? Do I know the same thing? Do I understand the world in the way that I thought I did? And I was doing it myself. I was looking at exercise periodicity, and I was convinced that the way to exercise is to periodize, strength and hypertrophy and aerobic exercise, because that was the Bible 15 years ago. But I took some time off over the December to reread the material, and the latest research shows that it's not necessary, right? But I've been going on a 15-year-old playbook, right? So we all need to do this in every aspect of our lives, and our personal finances are the ones that need it the most, I think.
It's hard. A lot of people, we're lazy. People are inherently lazy. I freely acknowledge that it can be lazy too. Once you've got something that's more or less figured out, once you're pretty sure you know what you're doing, you oftentimes people tend to stop being curious. They just say, oh, I got that down. And they move on to something else in their life. And the irony is that what you have down was what was down for 5 or 10 years ago. But in 2023, you haven't kept up. And it's difficult for anyone to acknowledge that they haven't kept up, especially if they think of themselves, if their self-image is one of, no, I'm a responsible person. I don't do anything recklessly. And they don't think of not keeping up as being reckless. And it isn't necessarily, but it certainly can be. And I'm going to pound my fist on the table, reflect, stop, seek, review. Don't just think that you're fine. Continue doing what you've always done on the assumption that it's always worked in the past, and therefore the past is prologue and it's going to work in the future, because that's when it bites you. When you become complacent, when you become full of hubris, when you think, oh yeah, this is fine, that's when you get hit with the bullshit, and the optimism bias sort of bites you more than anything else that you could have expected.
Yeah. And to your point, John, I think, I brought up the fact that a lot of investors have moved to de-risk, but that wasn't a proactive thing. Yeah. That was a reactive. Exactly. That was a reaction to the fact that both equities and bonds were falling. Prior to the end of 21, you couldn't have enough money at risk, and following the change in tack of the Fed and central banks in general, you had too much at risk, but the reaction, so I think the key is also just to get into discussion about, if you're going to be reflecting on your portfolio, you're going to be reflecting on your financial planning, your outlook, all of your, beliefs that brought us to this place that we're at now. You also have to take a more proactive stance as well in portfolios. It's not a matter of just reacting. The market seems to be like on a hair trigger, at every, word that comes out of Jerome Powell's mouth, and waiting for some indication that they're going to pause, because the pause is, the pause. And that's become akin to the put. But it's not quite the put. I mean, I think, the pause is just the pause. It's not pause and then cut. It could be pause and then pause some more and pause for more. It could be pause for years, as far as anyone knows, until the central bank, until central banks, the Fed, is satisfied that they have kept at it long enough, as keeping at it, as Paul Volcker once said, and as Jerome Powell has echoed. How long can they keep at it? And so really the question becomes, what can you do now to create or to change or modify your portfolio so that it takes that into account, so that it takes the uncertainty of all of that, of what a longer, higher rates for longer means to the market, how inflation volatility causes certain reactions in the market or dislocations in the market. China coming on stream now, for example, could put a wrench in the works. We got used to China being on this zero COVID thing, on a zero COVID mission. And now that they've opened up and they've reopened and they're looking to get back into the global economy again, under more normal circumstances, that growth or that consumption from China could set things back again in terms of the expectations that people have built up. So you see this hair trigger reaction. The market, I don't know if it's just short sellers covering because they got scared because the Fed might indicate a pause, or that's obviously a big risk. That's one kind of buyer in the market that drives prices up. But that kind of hair triggered sort of optimism that we got used to the last decade, it's not really found. It's not very well founded now. So John, I think just to transition in our conversation, what are some of the ways, what are some of the like baby steps towards adding alternatives to portfolios? What kind of investments are I mean, just in general headings, of course, but what kind of alternatives can be the starting point of the journey to adding alternatives?
The thing that I would point out for your viewers is that everyone's fighting the last war, and everyone's assuming that the what happens in capital markets now will be akin to what has happened in the past. And I think the first thing that I would say is disabuse yourself of that notion that things can in fact be different. Without going into too much detail, I'm not comfortable talking about exactly which asset classes. I think there are 4 or 5 different broad alternative strategies and alternative types of products out there. And if you were to look at a traditional, again, just as a standard 60-40 portfolio, depending on who you're working with, what the compliance department says, what your appetite for risk is, how certain products are rated, because some will be considered high risk, as Rod has said, and others will be maybe some other forward-looking compliance departments will say, well, the underlying is such that the standard deviation means that it should just be a medium risk product, even though it's an OM product, for instance. A lot of people will just say if it's an offering memorandum product, it's high risk just by virtue of it being an OM. And I think it's that kind of overly facile way of looking at things that is dangerous on the other side, because again, it's the old school way of looking at things. And you want to have firms and advisors that can be a little more thoughtful and just look under the hood and say, okay, well, what actually works? But what I would say is, without naming asset classes, you want to find things that have reasonable risk-adjusted returns up and by themselves, but specifically those things that have reasonable risk-adjusted returns on a weekly or non-correlated or ideally, at best, not negatively correlated basis. Because what you're really trying to do is to maintain the optimism that's required to stay invested for the long run. It does no one any good if they build a portfolio that they think is right for them, and let's say it's 60-40, and they think 60-40 is right for them because it has been throughout their entire lives, and now their 60-40 does something rather less than anything that they've experienced before. And in fact, 60-40 in 2022 was one of the, I think, 3 or 4 worst years in all of recorded history for a 60-40 portfolio. So, and I'm not suggesting this is going to happen, but it wouldn't shock me if 2023 was broadly similar. Certainly on the equity side, I don't think the income side is going to see that kind of a drawdown again. And so everyone's fighting the last war. Everyone's playing this game reactively. But if you're listening to this at home and you're thinking about what you could do, there's still time to proactively look at things that you can put in your portfolio that can manage the risk going forward, irrespective of whether or not you did anything looking backward.
Yeah. Now, John, I wasn't trying to pigeonhole you into an outlook on any given asset class, but there are obviously, there's the plain vanilla type of alternatives that are out there as alternatives, or assets that are low correlate, have a lower correlation or uncorrelated to equities or bonds, like real estate and infrastructure. And so without actually making an opinion about either or asking you for that, I think, or gold, real assets, in the sort of simpler commodities that you could choose from. And then, from there, you can obviously look at commodities. Rod, that's your cue.
Yeah,
you can look at commodities. Then from there you can start looking at more advanced alternative strategies, like anti-beta type strategies or strategies that are long short, merger arb. There's so many, so you could go from the very simple alternative set, the plain vanilla alternative set that are asset categories that have historically low correlation, to hedge fund type alternatives, which are structurally correlated in some way or uncorrelated to the traditional portfolio, right? So I think also the plain vanilla type investments are naturally are said to be naturally uncorrelated. But as you get into the more advanced, structural products where you have hedging and long short type situations or risk parity, or you're getting into strategies that are structurally uncorrelated, so that when correlations go to one, like we saw with equities and bonds last year, those structurally uncorrelated assets stay uncorrelated, right? So
what I would say, Pierre, is that if you should be prepared to have at least two strategies, and I don't think it's particularly useful to have a less than 5% exposure to any given asset class or strategy. So I would think that at a minimum, people should be looking at two of the laundry list things that you talked about at 5% each. That would be the minimum, and 3 or 4 at 5% each, or maybe 2 at 10, or 1 at 5 and 2 at 7.5, or something like that. I think at less than 5%, it's sort of the marginal utility of adding a diversifier at such a low exposure is questionable. But then it becomes a question of your appetite and who you're working with, and will they allow you to go to 15 or 20 or 25% in alternatives? And many firms won't. But however, I guess maybe the first order of business that you have to look at is, well, how far, if I wanted to go further down this road, how far would I even be allowed to go based on who I'm working with? And then from there, you say, okay, well, I've only got, pick a number, 15% that I can allocate toward alternatives. Where's that money going to come from? Maybe it comes 10 from equity and 5 from income. I don't know. I'm just saying. And then it's like, okay, well, now I've got 4, 5, 6 different ways of playing this alternative game. Maybe I should find 3 and put 5% into each of them. And so it's sort of like a sequential thing. Okay, let's be purposeful. Let's not just use a shotgun and just, ride off in all directions. Let's think about how far can we go? How far do we want to go? Where's it going to come from? What are we trying to achieve? And how can we actually get to a point where the overall portfolio will allow us to stay invested? One of the things that I talk about in the book that we haven't touched on yet is prospect theory. I don't know if you guys are familiar with the work done by Danny Kahneman and Amos Tversky. So these guys have shown pretty clearly that, and the evidence is overwhelming, that the pain of a loss is oftentimes twice as severe as the joy of a gain. So if you can just avoid large losses, that alone is going a long way to not only meeting your financial objectives, but also allowing you to sleep well at night and not be stressed at work, and getting along with your spouse and your kids and whatever else, because you're not diverted into being stressed about things that in the past didn't used to stress you. But if we have a major drawdown, they might.
Yeah, myopic loss aversion is the biggest thing that we struggle with as human beings, right? So, I mean, the issue ultimately is the fact that most years in the S&P 500 or Canadian developed equities, most years you're seeing pretty solid results, right? And so what are you asking people to do? We're asking people to allow to have a non-correlated stream just in case there's a bear market, just in case there's some inflation. What that ultimately leads to is diversification, which we at first blush feels really good and sounds really nice. But they only want the diversification, in my experience, that makes money at the same time as the rest of their portfolio, right? They don't want the diversification that they don't want, right? And you get diversification even when you don't want to. And sometimes that means taking away from that year's return as you give back some of the money that your alternative asset class or alternative investment vehicle has done for you in the previous year, right? So this is the big issue again, is going back to bullshit, is that we have indoctrinated people so much to really, really care about the yearly results of equities without the recognition that a single year can take your annualized returns from 15% annualized to 5, right?
Yeah.
That's the problem there. And then because of myopic loss aversion, at the worst possible moment, many people who don't feel they know what's going on are making bad decisions about their future and their investments and not allowing for that recovery to happen, right? So you
and that just compounds it.
Hurt yourself in terms of annualized compound return, right? So I think we need to really have more and more education on why you should not care about those double-digit returns most years, because you never know when that double-digit negative return comes and wipes all that away, right? It's the
And one of the behavioral quirks is anchoring. And unfortunately, if your portfolio was worth, $890,000 in January of 2022, and then your portfolio drifted downward, and now you're at, $726,000 or whatever, you're still anchored on that higher number because you had that money. It was there. It was, you can see it it was real to you. It was in your portfolio. It was on your statement. And you've got tangible proof. Look, Your Honor, this is what I had. I really did have this. And now it's like, well, why can't I still have that? Well, risk and return are related. If you want to be able to get a higher long-term return, you've got to be prepared to accept a certain degree of risk in order to get that. But human nature being what it is, people just
it's all the anchoring, right? So you
really the cost of
you really have to be a very special human being to buck the trend. But I think I remember by the end of 2009, people were thinking differently, right? And so maybe it takes a few punches in the gut to force us to wake up and do something better long term. Hopefully not. The ideal thing would be to think, reassess, educate yourself, and demand the right thing from your professional advisor or yourself. And that does require putting things in like I said, I love the piston analogy in the motor, right? You want things that are pushing the car forward in a smooth way over time. And that requires things going up and things going down. And that creates a smoother ride. If you have, sadly right now, it's not even 60-40, let's be honest, right? Up until 2020, it became 80-20. Maybe the 20 wasn't really government bonds. It was more like private credit or something like more that gets affected by growth. So all of a sudden you have this big, massive piston that's kind of, getting you really strong and high speeds under normal circumstances with a paved road. But the moment you hit some gravel, you need that bond, you need that, maybe that commodity, that gold, that alternative sleeve to smooth out that the performance of that car.
When
right?
the bulls are running, people tend to be slow in rebalancing their portfolio because, the old saying is, if it ain't broke, don't fix it. And as long as you're making money, we can push off the rebalancing until next quarter or maybe the quarter after that. We're fine. And you're unwittingly taking on more risk. And as long as the downturn doesn't rear its ugly head, you don't even realize it. You're actually rewarded for doing it. But at some point, the music's going to stop. You might find yourself without a chair. And then what? And as long as you really are okay with that, and it's easy to say you'll be okay with it as long as the music is playing and you're making money. But let's just see someday, I don't know when, someday the music's going to stop. And even though we had a fairly significant drawdown already in 2022, I don't think we're out of the woods personally. I may be wrong. I hope I don't. But I'm worried about how people are going to react the next time there's a major drawdown, whenever it is.
So there's two main objectives of alternatives, right? There's return enhancer. Alternatives can either be return enhancers, like uncorrelated return enhancers, or they can be uncorrelated volatility reducers. Not on their own, but in the context of a portfolio, right? I mean, I think when compliance, or when investors look at alternatives on a standalone basis, it's very hard to see why would I buy this, right? If you look at a long-term alternative that has a particular strategy and an intended outcome, if you look at it by itself, you're looking at it and you're wondering, why would I ever want to own this thing? Look at it, when the market was strong, it was doing nothing, right? And then we're sort of programmed as to this, optimism bias that everything that you own should be doing well all the time, right? And then we get upset when it's not, and we're saying, oh, I wish I had taken money off the table. I wish I had moved reduced my risk last year. To your point, John, or earlier, but if the objective is either return enhancement or volatility mitigation or some, in between, some combination of those two, and it should only be made in the context of a portfolio, not on a standalone alternative basis, for the most part. And I'm not saying all alternatives are the same. You could own a hedge strategy as a long-term holding, and be quite happy with it, assuming your capital assumptions are the right place. But that's part of the problem. I think when investors look at a standalone alternative, they can't see why they would want to own it because they don't have the context, right? So it has to always be like if as an advisor, you're going to present it to your clients as something they should add to their portfolio, then it should be done in the context of their portfolio. Here's your portfolio that you've owned for the last 5 or 10 years, give or take, a few changes and rebalancings. If you can provide that, and then reallocate historically, like some, a back test to show here's what your portfolio would look like in 2022 if this alternative was in there. That would be a better way of showing clients, showing the end investor how the alternative performs in the context of the portfolio, and then maybe the light bulbs go off then, and they're able to say, okay, now I get it. I wouldn't have bought this thing like I wanted to buy Tesla 2 years ago or 3 years ago. I would have bought this thing because I wanted to avoid losing money. And that I think has the potential to, when you're able to add on, I don't want to go on too long, but when you're able to add alternatives to a portfolio that actually smooth the ride, as Rod was talking, that piston analogy, where you have, a V6 or V8 engine, all the pistons are moving at different times in different directions, up or down. It's not all different directions. Sorry. Great analogy, Rod. I don't want to destroy it.
It's all good. It's all good. We're all expanding and trying to communicate as best we can here on these. But these things, right?
I think that's the part. I think that's the part that investors have a hard time. If they look at the standalone strategy, it's not very exciting, or it's very complicated. And I think that's the challenge advisors have, getting their clients and compliance on board with the changes they might want to make.
I think that's one of the reasons why advisors are so important, because you talked about context. And if you looked at alternative products as standalone products, you'd probably say, I don't know why I should really own this. But if you say, okay, I'm not buying a product, I'm building a portfolio, and adding this to an overall portfolio makes it more robust, makes it more something that I can live with, that will improve extend the outer boundary, the efficient frontier, getting there the highest return for the risk I can tolerate, then that becomes the sort of win that people will go, aha, and the light bulb goes on, and people realize, aha, this is why we're doing it. And it's not obvious. And a lot of people, unfortunately, you're exactly right, Pierre, they don't want to hear that thesis when things are doing well and markets are going up anyway, and the traditional portfolio is doing fine. And so now what you get is you're actually sort of, you're barring the door after the horse has left the stable, proverbially. You don't actually put in the things to mitigate the risk until the risk mitigation requirement has now more or less passed you by. You realize after the fact, well, this is what I should have done. Well, I'm going to do it now. Okay, well, good. And as long as you can, keep it as part of your strategy going forward, then it's better than nothing, I suppose. But really the best time to do it is as soon as possible.
Yeah. And I think one of the things that people...
This is an opportunity, right?
Speaking again, well, it's an opportunity because I think the first thing that people should take away from today's discussion is to examine everything, right? One of the things that we need to examine is the belief that the Fed managed to rein in inflation in a year, record time, and we're done, we're going to hit 2% and it's over. We can go back to playing 2D chess again, right? The reality is that for the last 40 years, inflation for developed markets has not been an issue, right? If you think about the continuum of what the Fed has had to deal with, is they've had to inject liquidity when there were growth problems without having to worry at all about inflation, right? Every time they injected money, they couldn't create the inflation even if they wanted to, which is a great thing. You're basically advisors, investors, and even the Fed was balancing on a barrel, right? They either had to go forward or backwards. It was a two-dimensional game. It was fairly straight, not easy. Investing was never been easy, but you are literally on a two-dimensional scale having to deal with the problems. just inject money whenever you want growth again. And you'd see these V recoveries and people would benefit from that. They'd recover quickly from these drawdowns. As a Latin American, I can tell you that the moment you inject inflation in there, you're no longer balancing yourself on a barrel. You're balancing yourself on the top of a bowl. And that creates portfolio gyrations that are unexpected, that are more complicated than you've ever had to deal with. You are now having to understand what the impact of inflation and disinflation have on your portfolio's growth and negative growth. And in that environment, the Fed doesn't just come in, do something quickly and fix it. The Fed is going to overshoot it or undershoot over time. And trying to find your balance again from a Fed's perspective after 40 years of having no expertise in doing it is going to take them time, right? When people were talking about this disinflation, right? But if you take a look underneath of what's going on with inflation going from 8% to 6%, there's components to it that are transitory for sure. Prices of asset classes, of gold, of oil, of grains. But there's the biggest component, which is labor, that is getting sticky and is staying higher and it's likely to stay higher for longer. So we might find that we're seeing the overall picture of inflation go down, but they're not seeing this other thing that's stickier and longer. And that's the what happened in the 70s, which is labor inflation. That could mean a whole new paradigm where inflation becomes a really, really tough thing to deal with for the Fed. Fed's going to make mistakes. And if you are still playing 2D chess or you're still doing that two-dimensional balancing, you're not going to be doing what's best for yourself and your client, right? So again, this is, I think, I agree, John. I think it's not over. I think it's complicated. I don't know when or what, but to not be prepared, this is not about prediction. This is truly about preparation, right? And what you need to do in your portfolio today, in spite of what we think is over the last 12 months, what we can do today to just create a more balanced portfolio so that you can balance on a ball.
So
other analogy
I love it. I got a question for either one of you now. Like for the last, I don't know how long, like for the last couple of years at least, the dollar has been king, right? That's been one of the best performing assets, the U.S. dollar. Now the U.S. dollar is coming off its dominance. I mean, or its strength. I mean, and maybe both. If what was being said was that when the dollar was strong, the U.S. was exporting inflation, is the reverse true? When the dollar weakens, is the U.S. now, with under a weaker dollar, now importing inflation? Does that not throw a wrench in the works as well? I mean, it's great for commodities. It's great for anything priced.
Yeah, exporting disinflation would be the more direct incident. I don't know. I don't really have a strong opinion on that. That's sort of like the 3D chess. So maybe I'm moving parts. Yeah, the guy that only knows how to sort of roll a barrel and doesn't know how to stand on a ball. I'm not sure, and Rod, I'll let you answer.
How many people actually understand the dynamics of that?
No, but this is the thing, Pierre.
I mean, how do you read that? Yeah,
this is the point. This is the point.
Yeah,
that's my point. Yeah, that yes, that is an element of this inflation number, right? Inflation. We wrote a long piece on the different facets of inflation. Inflation is a very multifaceted thing, but yet in the average media, you hear an inflation number, a single inflation number, mainly the U.S. inflation number, not even the Canadian one, right, or the global one, the European one. We don't really know or care about those things. So it is very complicated. Is it supply side inflation? Is it demand side inflation? Is it a little bit of both? Which one's going to be sticky? Which one's not going to be sticky? Right. But the big message here is that we're talking about inflation. Whatever that is, it's here. And the Fed knows it's here. And I know, like, ask any Brazilian what inflation does to your planning as a business. Right? You're just less willing to take a lot of risks, to outlay a lot of cash up front. You know, it's going to create uncertainty for businesses. It's going to create uncertainty for the investors of those businesses. All right? Inflation volatility is, I think, the thing that is more likely to exist in the medium to long term here, because like I said, we're going to overshoot and undershoot, right? And in this inflation, when there's uncertainty, whether it's through the U.S. dollar or otherwise, when there's uncertainty about cash flow in real terms, what tends to happen is that the financial markets start lagging the real economy. Okay, let me kind of just take a step back and explain what I mean by that. From 1966 to 1982, the U.S. economic growth was very similar to the U.S. economic growth from 1982 to 1997. Right, so 16 years, in the first 16 years, economic-wise, similar growth than it was until 1997. But from financial markets perspective, from 1966 to 1982, the Dow Jones returned around zero. Okay, financial markets lagged the economic reality. But then from 1982 to 1997, the Dow annualized at 16%. So I think one of the things we need to understand here is that the price to earnings ratio, the Shiller PE ratio that was at, I think 38 in November of 2021,
Yep.
was at 5 at the tail end of 1981 and 71, right? So again, economic growth the same, but the financial markets are either lagging or they're overshooting. And inflation volatility, uncertainty, people are going to require a higher risk premium today in order to put real money back into the market. And in fact, there's going to likely be more, if history is any indication, that volatility is going to lead to the multiples collapsing, earnings probably changing, and that's going to take a long time, right? We're in the third inning, in my honest opinion. And so there's still time.
I had about 15 pages of cyclically adjusted price earnings that I had in the book that my publishers at Dunder said, take that out. The average reader won't be able to follow. And so writing books could be
That's fair. I mean, it is pretty esoteric. You're right.
It can be, but just for the sake of the people staying at home, since I get a chance to actually talk about CAPE. CAPE is the cyclically adjusted price earnings ratio. It was developed by Robert Shiller. Shiller won the Nobel Prize, along with a few other people in 2013. And his research was originally applied to real estate, but it's also applied to things like stocks. It's notoriously bad at timing markets, so do not use CAPE to time markets. But to your point, Rod, I'm now dating myself. I was in first year university, and my first year economics prof in 1982 said, "You can't make money in the stock market." I actually had a prof, first year university, says, "You cannot make money in the stock market," because from 1966 to 1982, he hadn't. And so now everyone's fighting the last war, and this guy's convinced that for the better part of a generation, he hadn't made money, and therefore if he can't, no one can, and therefore don't even try. So it's funny how a lot of people will look at what they've experienced in the past and say, well, this is the way things go. And then also the other thing that I'll touch on with the CAPE for the S&P 500 being at 38 about 15 months ago was that I talked earlier about the Nikkei not being back to where it was. Well, that's because the Nikkei 225 was in the 80s. In 1989.
Yeah, that was bonkers.
So,
1989.
Again, this is the point that I would make is that for the people who say, oh, I'm a 60-40 investor or I'm whatever, if you have a set asset mix and you don't pay attention to things like valuations, like BE ratios or CAPE ratios, you can be unwittingly taking on a massive amount of risk and think that you're disciplined because I'm a 60-40 investor. Yeah, okay. But if you've got if you're in Tokyo or Kyoto or in Osaka and you've got almost all of your 60% in equities in Japanese equities, and the CAPE on the Nikkei is 83. Holy, are you taking on a lot of uncompensated risk? And those people, I'm sure, the very last majority had no clue. They know it now because they paid for it the hard way. But most people today don't realize that. And so again, the CAPE at 38, less than just over a year ago, was, I think, the second highest reading in history for the CAPE and the S&P 500 after only after the technology bubble. And a lot of people were fat and happy and making money, and they didn't realize that they were exposing themselves to risk. And we've seen some of that come off now, and I think the CAPE is in the mid-20s for the S&P 500 now. But again, that's with the overnight rate being much higher. So you can sustain a higher CAPE ratio if the alternative, the risk-free rate is close to zero. But if the risk-free rate is getting up to 4 or 5%, you best be looking at a lower valuation in order to manage your risk. Otherwise, you're going to be in for a world of hurt, my friend. So that's something that investors don't think about.
100%. I can get into the math of it, but it really is just common sense here. if there's more uncertainty of future cash flows, investors will demand a lower entry price before they put a lot of money to work. It's just the way it works. So if you look at high inflation volatility periods, like the 1900s to the 1920s, or 1940s to 50s, 70s, the decade of the 70s, the average KPE was in the single digits. Now, as the rates start going down and inflation volatility gets lower, and there's more certainty of future cash flows, and people are much more willing to let go of their money because the future is more certain in their eyes, right? So this is when growth stocks go through the roof. All right. So it is something. Again, you're right. You can't use this to time the market. You would have been out of the market for 10 years. But it is an important thing to take into account as you're creating a long-term investment policy statement that understands the risks that you're taking that may or may not materialize, but you need to understand that in your lifetime may or may not materialize, right? Or in your personal investment horizon, but it needs to be assessed. And you need to be able to understand what happens if the worst case scenario happens and what you can put in your portfolio to offset those. That's it. So yeah, I do think the key thing here is not to think that it's over, that the chaos is over. I don't know, the chaos may be another bull market and I'm wrong for another 10 years, but there is going to be dispersion. There's going to be opportunities and there's going to be losses in asset classes that your intuition would have told you historically that are not likely to happen. So again, it really is a good time still to reassess your options and what you can do for investors.
Well, one thing I think that's funny, sorry, John, and then is that it seems at times, it seems quite a bit that investors, people who are in the markets, are actually hoping for this much anticipated or most anticipated recession to actually happen, so that the Fed is forced into cutting, right?
Sure.
But really, what are the consequences of this actual recession occurring, of 1 million people being out of work in the U.S. Following the aftermath of the slowdown that they're talking about? What are the actual consequences to earnings and demand? And I mean, there's so much destruction that happens in order for that to actually happen, so that you get the cutting. And then does the actual cutting, I mean, if people are making forecasts based on their expectation that the Fed is going to cut, then what, again, these are the moving parts, right? What is the actual outcome? What does it do to stocks? It'll most likely benefit bonds. If yields drop, we'll have the duration benefit from bonds, but it won't. It may or may, it's anyone's guess as to what happens to stock prices. The market, that hair trigger that I was talking about before, where the market reacts positively to bad news, the bad news is good news idea. What happens if the recession actually becomes very firmly bad news is bad news, period? And again, that's an unknown. I'm not saying that that's what's going to happen, but we have very little idea, except for 2008 and 2009, what another recession looks like, especially, given, go ahead, John.
Sorry. The people who are talking about a pivot are saying either that central banks aren't serious or central banks will lose their nerve or whatever. But looking at it objectively, if we have, say, another 50 basis points in hikes on both sides of the border over the course of the next 60 or so days, and then we have a pause, not a pivot, a pause. Mm-hmm. We just keep rates where they are, and then what happens to the economy? I would think that if inflation is still running in the mid-single digits, I don't think you can really afford to have a pause. You have to still keep on fighting that inflation in order to get it down to the stated objective of 2%, give or take 1%. At some point, it will be a house of cards and it will fall down. The only time when you actually can start pivoting is when there's pain. So it needs to be a two-step process. You need to basically manufacture pain and cause jobs to be lost. And then when the jobs are lost and mortgage rates are higher than anybody's experienced in their past generation, there will be foreclosures, not only because of rates being high, but because the people who are, if you're a 2-income family and one of the two people loses their job, it's hard enough to keep on making the mortgage payments when they were at 2%. But now that they're at 5.5 or 6, one income, you're probably going to lose that house. And so now you have
absolutely, like no one's
everything going wrong. And that's when you actually finally have a pivot, but you need to have significant pain first. I don't think you can pivot without the pain. So for those people who are cheering on, saying, bring on the pivot, what they're really saying, in my opinion, is bring on the pain so we can pivot. Because I do not see any scenario whereby central bankers can pivot unless we actually start seeing significant job losses and significant downward pressure on inflation, which it's downward pressure, but it's nowhere near enough at this point.
Well, yeah, and you know, to your point, John, on the mortgage payments being, you know, one of the largest components to consider. You know, what are the payments now? They're 2.5 times what they were a year ago for anybody renewing. So you know, 2.5x on your mortgage payment. So now if you had a $5,000 payment a year ago, now it's $12,500.
Yeah, look,
right?
but again, all of this.
I'm
speaks
sorry,
to
a
path
$5,000 payment
right?
is, you know.
All of this speaks to
but a
path
$2,000 payment and now it's spotted. It's still significant.
Yeah.
That's $3,000 a month. That's $36,000 a year. Most middle class dummies don't have that kind of money hiding under the mattress.
And then the longer, if rates are longer, are higher for longer, or even level for longer, without a pivot, then you know, as time goes by, more and more people are renewing or trying to renew their mortgages going forward, right? As they roll over, and then you start to see some real problems for folks who had 5-year mortgages, you know, pinned at let's say 3%. They're probably okay for a while, but for anybody else that's got a variable, or anyway, I think that alone is a serious consideration, just to put in context of what we're talking about, which is that, you know, portfolios need to be more fortified. They need to, you know, you need to stop, you know, looking at the short-term possibilities of what will happen in the market this year, and start looking at how can you build a portfolio that has, you know, sustainability, that has, and I don't mean the ESG kind, I just mean, you know, that has a sustainable outlook where you know, you have the instruments along with the equities and bonds to provide either the return enhancement or the risk mitigation, the volatility mitigation against the traditional assets that you're holding. Right.
Amen.
So John, it's been, I think we could probably go on for you know, quite a while longer talking about this, but John, without giving away the climax of your book, do you have any takeaways? No, I know. I'm just being funny now, but there's got to be, you know, I'm guessing, as with most books and essays, it comes to a conclusion at the end about what comes next or what to do next. But without giving that away, because we do want people to.
I'm happy to give you a broad brushstroke without going into specifics. So the main point here is that you working either individually as an investor or in concert with an advisor may be unwittingly taking on more risk because of optimism bias than you think, and you may not be doing enough to prepare yourself for it because it hasn't been a problem ever in your investing lifetime. And as a result of that, you're being blindsided by your sort of, there's a sense of complacency that I see investors have in 2023, that they should have hopefully learned a lesson from what could happen by what happened in 2022. I don't think we're out of the woods with regard to COVID. I think there are a lot of there's a chapter here on public policy because I'm a policy wonk. There's you know, some experiences about the media and what the media does. There are a number of different culprits, if you want to blame culprits, but ultimately it rests with you, the investor, to make an informed decision about what you're doing with your portfolio. And the thing that I would say more than anything else is you need to guard against being overly optimistic to the point of being naive, to the point of being hubristic, to the point of actually thinking this will be fine because it always has been fine up until now. Just because it worked in the past doesn't mean it will work in the future. Please stop, reassess, think about what you're hoping to achieve, and a great way to game this out is to have what's called a pre-mortem. You know how when people die in the murder mystery, they have a post-mortem to figure out who done it and whether or not he was poisoned, or if the gun killed him before the knife killed him or whatever else. This is a situation where you can look at your portfolio, and if you think about, okay, what happens if, as Rod says, we have long systemic inflation? Have you thought about that? What happens if we have a situation where the CAPE ratio goes from 27 down to 7? What happens? And have I thought about all the different things that could go wrong? And none of them, I'm not predicting any of them will go wrong necessarily. I think I've said this 5 or 6 times on this episode here. This is not a prognostication. This is a earnest request to stop and reflect upon what you're doing and to guard against what could go wrong, even if it doesn't actually go wrong.
Excellent.
I love that.
And John, as an advisor, yeah, I love it. I just, one more thing, as an advisor and a PM, what is the solid takeaway that you can urge advisors?
Every single person on the planet is biased. So you as an advisor are biased. I'm not saying that as a criticism. I'm not saying that as a diss or anything like that. Not at all. To be biased is to be human. We're all human. We're all biased. I'm biased. This is not sort of casting aspersions on anyone else. This is saying acknowledge that as a human, you're going to be biased. And as a biased human, you need, if you're going to be giving advice to retail clients, you need to come to terms with whatever your biases are or may be, and reflect upon what they may be, and do an inventory about, am I biased with regard to being optimistic? Am I biased with regard to my past experience? Am I anchoring on my various performance numbers or portfolio numbers? Am I thinking about the status quo bias and it always worked in the past? Am I whatever it is, am I engaging in some form of narrative fallacy where I've got a story that I'm telling people in order to justify what happened in the past, and maybe I can use that to justify things in the future? There's a whole host of cognitive biases that we are all subject to, and that especially is a factor for advisors, because advisors hold themselves out as being behavioral coaches. And how can you be an effective behavioral coach if you're not even fully mindful of the biases that you yourself have? How can you give someone else advice as to how to manage their biases and manage their behavior if you're not even fully aware of your own behavioral quirks? So you need to do a careful inventory of what you're doing yourself in order to do a better job for your clients. And that's what we all want.
Excellent point, John. Thank you so much.
Yeah, very good.
And thank you so much for your incredibly valuable time, John. It's been an amazing discussion. I think lots of food for thought. Thank you.
And where can people find you, John?
So
get a hold of you.
Pierre, Rod, thank you very much for having me. It's been a real pleasure. I have my advisory site is standupadvisors.ca. If you want to just read more about my book and my blogs and the other things that and the articles I've written and where I've appeared, you can go to standup.today. So in both cases, it's standup. So standup advisors with an O, advisors.ca, or standup.today.
Excellent. Amazing.
Excellent.
Thanks, John.
Thank you very much.